God's secretaries to the house. This is Pastor Efe. Before we delve into today's topic, I would like to share some facts with you. The era of fiat currency is gradually eroding away because the rate at which countries are upgrading their financial system into digital currency and also adopting some cryptocurrencies as a legal tender is a big proof. Those that had the insight early enough about the impact that crypto could make, I've actually made a fortune with it. I know of someone that have bought a car and lands courtesy crypto. I must tell you the truth that cryptocurrency is the only investment that I have seen so far that can triple itself within a very short period of time if properly guided. Now, take a look at this. Courtesy greetings. This is Pastor Efe. Take a quick look at this. This is my future trading account. This is my account history for this month of January. Now, the last trade I made was people and the P&L, that is profits and loss. The profit I made was $208. Then this is SPA. I made a profit of $587. Look at Goldfin. I made a loss of $9. Look at Baby Dodge. I made a profit of $1,289. Look at Baby Dodge. On the 2nd of this month, I made a loss of $208. Now, what this implies is that people are still making it big time in crypto. I actually decided to upload this clip just to let you know that you shouldn't give up on crypto. A lot of persons have made losses in crypto as a result of lack of knowledge, high level of fear, and greed. In a nutshell, I want you to still know that you can make something out of crypto. What you need is a good knowledge and strategy. If you have a good strategy, you're good to go. So this year, you can make something great out of crypto. All you need to do is map out a little time to learn, study, go on YouTube. All you need is there. I repeat, all you need is on YouTube. Read, download articles, read, and before you know it, you break even in crypto. Then I also like to be of help to some of us. While you are learning, you are reading, you are making your own research, to have your own good strategy. I want to help some of us here to make something out of crypto. So what I want you to do is log in into your Binance account. Activate your futures wallet, your futures account. That is future trading account. Activate it. How do you activate it? Just transfer fund to it. It will automatically get activated. Then go and activate your API for the futures account. Activate it. Send the API to me. So when I trade from my end there, it will reflect on your account automatically. All right. As you can see that there is a big returns when it comes to crypto, and the aspect of crypto that can yield times 3 percent of your total trading capital is actually futures. Now, I must tell you that futures actually has a very, very unique quality in the sense that it can fetch you ×3 of your portfolio in 1 week. What spots will fetch you in 2 months? But what makes it be highly dreaded is what we're about to talk about today, which is liquidation. And this is the aspect that actually make people to abscond from futures trading because of liquidation. So today we'll be talking about how to avoid liquidation in futures trading. Under this topic, we'll be looking at the following. We'll be looking at what is future trading, what is liquidation, strategies against liquidation. Let's dive in. So what is futures trading? Futures trading is trading underlying assets, that is virtual assets, with brokers' money. That is what futures is all about. You trade with brokers' money. While in spot trading, you trade with your own money. Let me explain further. Now, in spot trading, you actually trade with your money. Take a look at this. Assuming that you have 100 USDT in your spot wallet and you want to buy BTC with it, and the BTC is at the price of $44,000. That's $444,000 US. And you wanted to buy BTC worth of $100. It's going to fetch you 0.0023 unit of BTC. Then you decided to sell the units you bought at the rate of $54,000 US. It's going to amount to a total of $122 US. So meaning that you made a profit of $22. Now let's now see you decided to pick this same $100 and to trade on futures. So you took your $100, you took it to the futures, then you meet with the brokers and tell them that, okay, I want you to give me 5x of this $100 I'm having. They will borrow you. That is what futures is. You are trading with their own money, not actually with your money. So they're going to give you, they can even give you 100 times of this $100. So you decide to collect just 5x of it, and you bought BTC with that same amount of money at the rate of $44,000 US, and the total unit of BTC is going to give you 0.0114 BTC. Then you sold that unit you bought at the same price of $54,000 US, which are total amount to $615 US. So you have made a profit of $115 US plus your capital, which is $100. That's a total of $250. So you can now see the big difference. If you had used your $100 in your spot, you only make a profit of $22. You brought that same $100 to futures and it gave you more than 100% of your capital with the same trade. So that's one of the things that makes futures trading to be very unique. Now, let's talk about liquidation. What is liquidation? Liquidation simply means the art of selling off your futures position in exchange for cash. Now, in futures trading, it's based on contract and agreements. So when you hear that someone has been liquidated, it simply means the broker or the exchange sold his or her position to redeem their cash. So let's moving and you'll get to understand it better. Now, we are talking about strategies on how you can use to kick against liquidation. So number one strategy is use of stop loss. Use of stop loss. Now, when we talk about stop loss, it's actually a way whereby that you anticipated that, okay, the market should go this way, and the market start going against you. So, but you already beforehand anticipated that, okay, if the market should go against me this direction, okay, I will not allow it to exceed this level. Then you put a stop loss. So once the market gets to that level, the stop loss will trigger and you will lose a little and redeem your other capital. Then the second one is leverage, reduce leverage. Now, this is very, very important. If you don't understand leverage in futures trading, you're going to make a big loss. And your understanding of leverage will also help you to make a good profit. Now, take note of this. The higher your leverage, the higher the level of your liquidation. The lower your leverage, the lower the level of your liquidation. So, for instance, right now, if you took 2x leverage, your tendency of being liquidated is very low compared to if you took 20x leverage. So, you need to understand what leverage is all about. Then, the third one is monitor margin ratio. Now, margin ratio simply means the money you use to open the trade or the contract. So if, as long as there is money in your margin, you will not be liquidated. So for instance, right now, if you enter the trade with $50 and the market reverses against you and you are going downward, your $50 has reduced to 30, has reduced to 40, to 20, has reduced to 10. If you add money to it, you will not be liquidated until the market reverse. But if the market fails to reverse, it will still be eating deep into your money. Although I don't use this and I don't advise people to use this. So the last but not the least strategy, which is what I use, and that is what I want to share with you majorly today. Okay, now it is called cost averaging. Cost averaging. Now, if you have been trading sports, you should know what dollar cost averaging is. That is what we are also using in futures here. But the way it applies to sport is different from the way it applies to futures. So follow me. Now, let's take an instance. Look at this. This is my trading account here. You can see it's actually a virtual wallet. So as you can see, this is 952 USDT as an available balance. Then this is it at the rate of 3,268.7 Naira as at this price, as at the time of preparing this chart. Then I decided to short this. Based on my analysis, I know the coin should be going downward. So I decided to short the market. So I entered the market. You can see it on 5x. The leverage I use is 5x. Then I bought 8 count. The count is units. So I bought 8 counts. Then as you can see here, this is my entry price, 3,268.70. Why? This is my liquidation price, which is 3,906.09. That's my liquidation price. You can see entry price / estimated liquidation price. Then this is floating P&L. As you can see, market is going the way I predicted it. Based on my analysis, you can see I've already made a profit of $4.8 and this is the money I actually used in entering the market. This is my margin, 52.4866. All right. So now, let's not assume that the market started going against me. Instead of falling, the way I analyze the market, so that's what's going up. So how do I mitigate being liquidated? Because if the price start going up, it means that it will be approaching 3,900. So how do I mitigate this loss? Then the next thing I'm going to do is to apply this cost averaging. Now, since I know that my liquidation price is 3,906.09, then I'm going to place a buy once the price gets to 3,850. Then I'm going to buy the same 8 counts. That is 8 units. Now, and that 8 units, look at what it's going to cost me. It's going to cost me $61 that's going to buy. Now, what happens to this? So let's go into it in details. Now, how cost averaging works. This is a sample of the trade. This is my initial price, my entry price, and this is my liquidation price. Yeah. Okay. So cost average in futures simply means last cost price plus present cost price divided by 2. Now, what is my last cost price? My last cost price is 3,268.70. Then my present cost price is going to be what? It's going to be 3,850. That would be my present cost price, with the mindset that the market wants to what? Liquidate me. So now see the mathematics here. 3,268.70 plus 3,850 divided by 2, a total of 7,118.7 divided by 2, then which is going to amount to 3,559.35. So which simply means that once I buy 8 count on that 8 count at this 3,850, my new entry price will now become 3,559.3, no longer 3,268. My new liquidation price, the liquidation price will now move up, which will now become 4,257.31. Then my new count will now be what? 16 units. So it simply means that I've increased the quantity of coins I am holding, units of the earth I'm holding, which simply means that by the time the market starts going in my favor, it's going to what? Increase my profits. And it also gives me a room to exit even at a price that I might decide higher than the previous one that I might have decided to exit the market and exit with profits. So that is how the cost average works in futures trading. So now let's move on. Let me show you a practical example. Take a look at this trade. This is OXY. I traded this coin. That was as of January. That was when I entered this coin. After looking at the market, based on my analysis, I analyzed the market to actually what? I short the market to go down. But the market was changed, because one thing we should know is this: the market is actually humans. It's humans that are trading the market. So a news can change the charts. A fear can change the charts. So in a nutshell, I analyze the market to go down. So I enter the market at this level. At this level, I enter the market, this red line. Then the market started going up and got to this level. Then I bought more at this level. Then the market continued going up again. I got to this level. Then I bought more again at this level. Then finally, the market went up and started coming down, came down, and got to this level. Then I sold at this blue line. I sold here at 0.4343. So now let's look at it. Now this is it here. Take a look at it here. When the market was actually 0.42. That's when I bought. I actually bought 500 counts. 500 counts. Then the market moved up to 6. Then I bought 325 counts. Then the market moved up further to 0.67. Then if you add all these together, it's going to give you a total sum of 850 plus. So then I bought 850 plus a chunk of it here at 0.67. So that was when the market started reversing, and it reversed down to 0.43. Then I sold the O, which was a total of 1,675 counts at 0.4312. Remember, I entered at 0.42. So, but because of cost averaging, I was able to sell at this higher price than initial entry. I made profit. So what does that simply mean? Take a look at this now. Let's do the mathematics. Okay. So now look at it. Initial old price, which is what? Which is 0.42 plus new price, which is 0.67 divided by 2. Then which gave me 1.09 divided by 2, which give me 0.545. So my actual entry price now became 0.542. So I now exited at 0.43. So that is how cost averaging works. Now, before I moved on to question and answering, I would like to let you know that futures trading is very lucrative if you have a good knowledge about it. For those of you that would like to know more about it, you can reach me on WhatsApp. This is my WhatsApp line, +234 80 366 02905. I repeat, +234 80 366 02905. Thank you.